Welcome to the ROBO Global April investor call and welcome to the second quarter of the year. Today on the call, we're going to have Bill Studebaker and Lisa Chai walking through all the key highlights from the last 3 months and looking at some of the trends we expect to see throughout the rest of the year. As always, if you'd like to ask any questions, you can put that in the question box in the Zoom window. And you can also email us at info@roboglobal.com and we will make sure to follow up with you. So I will hand it over to Bill.
Good morning. Thank you, Erin. We look forward to giving you a quick update on our first quarter results. We want to spend just a few minutes updating on who we are. We're going to obviously provide a review of the first quarter. We're going to talk about all three of our innovation indices, starting with the Robo Index, moving on to healthcare, and then into our AI index, THNQ, and then happy to answer any questions after that. So many of you know us as the creators of the first robotics and automation index, which we did nearly 8 years ago, but we now have added two other proprietary indices, THNQ and HTEC. THNQ is our AI index. It's our newest NYSE index that actually went live only, actually in 2018, but it didn't go live on the NYSE until a little less than a year ago. We obviously now have our healthcare innovation index as well. And what really kind of makes us unique is that we are really focused on a research-driven strategy where we're trying to identify the best-in-class companies in robotics, AI, and healthcare technologies. We are actively following in excess of 350 names across 42 of our subsectors and 27 different countries. What's also quite unique about Robo is our very low overlap with traditional indices. You'll find with the S&P as an example, less than 3% of our Robo exposure is actually captured there. We then sort of weave a strong ESG filter into our index, which we think is very interesting to do that a lot of other folks have not been as acute in doing. Moving on to our next slide here, these are our three proprietary indices. Robo actually captures 11 proprietary indices, or I'm sorry, subsectors. THNQ also 11. And HTEC, we have 9 proprietary subsectors that we classified, and we're really trying to, capture what is soon to be future growth, and are not many indices, but we think definitely should be. As you can see with our performance, all of our industries have materially outperformed over 1, 3, and 5 year periods. However, performance is never in a straight line. So we did see some modest underperformance in the first quarter after fairly large outperformance in 2019 and 20. During much of 2020, we saw the key beneficiaries of the turbocharging of digitization lead the gains. But again, we did see some modest profit taking as would be expected in the first quarter. As the next slide illustrates, the broadening of the economy and the market lifted cyclical and value stocks, which definitely helped Robo, given our strong cyclical bent and exposure to small and mid-sized companies. HTEC is also very favorably exposed towards small and mid-caps, so kind of benefited there as well. Next slide here. Interestingly, the Robo innovation indices have all continued to benefit from diversification, but also from the tremendous M&A tailwind that we're observing. And again, given our sort of small and mid-cap exposure, this has been a noticeable benefit. Year to date, we've seen actually 3 acquisitions. FLIR was actually acquired by Teledyne on January 2nd. Talon was sold to Thoma Bravo, a private equity firm, for roughly a 30% premium. And just a few days ago, many of you recognized that Nuance was acquired by Microsoft. Interestingly, both FLIR and Nuance are very old and established companies. FLIR actually started over 43 years ago, and Nuance 30 years ago. Both have gone through quite a few restructurings, but are great technologies that are now being augmented with other mature growth platforms. Teledyne was focused on aerospace, and FLIR was focused on government security, but both offer best-in-class sensing. Nuance was an easy fit or easy way for Microsoft really to accelerate their push into healthcare and to make a big bet on AI healthcare. This acquisition, we think, we're going to continue to see actually significantly more M&A in healthcare, given the low single-digit levels of penetration and digitization. Talend, just kind of rounding out, was a small French cap company that was acquired again by Thoma Bravo, really to help them accelerate their shift in spending in the cloud as a key data management vendor. Just moving on to discuss ROBO. As you can see, ROBO continues to outperform, or has continued to outperform, global indices. And we're quite comforted by our view that 2021 is going to be a boom year. And as the global economy reopens, this is going to benefit international, cyclical, and again, small and mid cap, where ROBO has been sort of exclusively focused. We can talk more about those exposures later if you have any questions. Moving into some of the sector highlights, 3D printing was the best performer in the first quarter. As you can see, was up 43%, but actually was up roughly 166% over the last year, reflecting the transition that we're seeing from a prototyping technology into a manufacturing technology. The momentum is definitely gaining steam, and healthcare, along with industrial manufacturing, are the principal drivers of the growth. 3D printing, which was anticipated years ago, is now, or anticipating to really kind of prosper, is now providing new sources of productivity and efficiency and growth. We think that we are in the early days of harnessing the innovation in 3D printing. As an example, in healthcare, organ and bone printing for pre-surgical procedures shows a lot of promise, and we're just scratching the surface here, which is going to and is resulting in lower costs and significantly better patient care. Logistics and warehouse automation performed quite well in the quarter. That subsector was up about 6%. As you can see, however, over the last 12 months, in excess of 100%, which is reflecting the rapid shift to e-commerce and the need for capital investment to service what is becoming really, as we all know, the preferred way to shop. The next slide here sort of looks at our proprietary classification by subsector. You can see applications are roughly 58% of our exposure, while technology is 42%. Just a couple anecdotes here. We are seeing a little bit of evolution and movement in the sectors and how they're growing. Manufacturing and industrial automation, when we first launched ROBO, was 18-19% of our exposure. As you can see, it's come down a little bit, while AI computing, as would naturally be expected, has been growing. Healthcare has continued to emerge as a growing area, and so is logistics automation. And you can see right next to it are the performance of the various subsectors over the first quarter and over the last year. Shifting to a couple of the performers in the quarter, iRobot was the best performer in the ROBO Innovation Index. It was up 52%. Obviously, many of you know iRobot as being a leader in autonomous robotic cleaners. They delivered earnings well above expectations and guidance, with revenue up 28% year over year, and internationally actually up 27%. Their product mix continues to shift towards premium vacuum cleaners, while their direct sales to consumers have more than doubled. iRobot is starting to really benefit seriously from their growing installed base of connected robots, now more than 10 million units, which is going to enable the company to engage more intimately with consumers and selling them more value-added services. But as many of you know, these are basically mini Teslas roaming around your house that are collecting vast amounts of data. Materialise, conversely, was actually the worst performer in the index, was down 34%, but over the last 12 months is still up 86%. This is a Belgium based additive manufacturing company with leading positions in 3D printing software and medical applications. It sold off in the quarter for the first time in their 30-year history after reporting revenues that actually declined year over year. This was really 100% related to the pandemic headwinds. Importantly, Materialise, we think going forward is well positioned to benefit from the continued adoption of 3D printing and disrupting the healthcare industry with leading applications for medical training, personalized implants, and pre-surgical applications. Yes.
Before we jump into HTEC, we just got a question about using 3D concrete printing to raise the walls on a poured platform in a housing development. And the question was specifically if we see any potential in this new kind of innovative application of industrial 3D printing.
Yeah, well, I think that again, we are in the early days of moving from a prototyping technology to a manufacturing technology, and I think the opportunities are virtually endless. Years ago, I mean, if you looked at the big 3D printing companies, the public companies, back in 2012, 13, you had a combined market cap of probably in the neighborhood of $13 to $15 billion, with revenues that were in the maybe $1 billion range. This has been seen as a subsector that, looking out 3 to 5 years, is going to be anywhere between 25 to $50 billion in size. So the applications are emerging, and we think offer a lot of promise in a number of different areas. Lisa, I don't know if you had any particular thoughts.
No, I think that's right. We've seen the shift going into more of the kind of the medical field at the moment, because the opportunity in the medical field is so urgent and very large. But I think that industrial market we're still in the early kind of innings of penetrating the industrial market. So all of the 3D software companies and services company that we've spoken to really believe that while healthcare is a very big kind of TAM opportunity, the current opportunity around industrial is also very strong.
Awesome, thank you. And speaking of healthcare, we'll let Bill go on to HTEC.
Okay, so shifting to HTEC, as you can see, HTEC outperformed pretty significantly in 2020, rallying close to 70%. We did see some modest profit taking in the quarter, which was expected, but we are really excited about healthcare and the future of healthcare, which historically has been sick care, but we're moving to a world of prediction, prevention, individualizing medicine, which ultimately is going to result in lower patient costs and in better patient care. So we think the outlook is very encouraging as we go forward. Shifting gears quickly just to some of the outperformers. Medical instruments was not the top performer, genomics was, but we did want to highlight this because it's actually the biggest subsector within HTEC, and it was one of the better performers. And given the size of the exposure, we're happy to see that we're beginning to see a big tailwind in demand, as given what occurred with the pandemic. A lot of procedures were postponed, and with the economy now opening up, people are going back to their doctors to get elective and non-emergency procedures done, which is providing a pretty meaningful tailwind for this subsector. Telehealth, conversely, was one of the worst performers in the quarter. Fortunately, it's only 3% of our exposure, and most of that was related to the pullback in Teladoc. Obviously, Teladoc was a massive outperformer in 2020 as the pandemic accelerated virtual care demand, and we did obviously see some profit taking, and there is some concern over Amazon's CARES entry. However, we think their acquisition of Livongo is going to help distance them from the competition and they've already disclosed their expectation to continue growing over 30% for the next several years, and as a leader in enabling physicians, to connect to patients in their homes. We think, again, the opportunity is quite meaningful. With that, I guess I'd like to pass it over to Lisa, who's going to go in more detail on the HTEC subsectors, and then is going to discuss our AI index, THNQ.
Okay, thank you, Bill. So as we go deeper into the HTEC portfolio construction, it's important to note that we have 9 subsectors, and this is a very diversified exposure of where we're seeing technology and innovation impacting the healthcare industry today. We can't stress enough that we have a very strong emphasis on companies that center around treatments and diagnostic tools around early prevention and early detection. And I think that's really what makes us unique. We think that is ultimately the holy grail of finding a cure for rare diseases and cancers. Companies in the genomic sector, data analytics, telehealth, medical instruments, and diagnostics are just some of the examples of subsectors where we're seeing next generation technologies are being adopted in the clinical settings for improved patient experience and minimally invasive procedures. For example, companies like Veracyte and Exact Sciences are companies that are using genomic analysis for cancer detection. Wearable digital health devices from Dexcom monitors and delivers treatments for diabetes. It's really hard to deny the power of these solutions. These devices are a really way of the future as physicians are looking for many ways to improve their diagnosis and improve patient outcomes. Our top performer in first quarter, Fulgent Genetics, shares were up 86% for the March quarter. It's a $2.6 billion market cap company. As you can see, Fulgent is not a household name. They continue to expand its next generation sequencing platform after seeing record revenue growth last year, mostly driven by the COVID-19 testing solution. Their FDA-approved diagnostic tests use molecular technology to detect antibodies and viruses, such as COVID and flu viruses. Shares are up more than 600% in the past 12 months, as they have increased their revenues by 10 times in the past year or so. We think that testing capabilities, especially around the rapid testing for various infections and diseases, are really here to stay. And we should see more innovation coming from Fulgent going forward. On the downside, HTEC experienced a mixed performance in the precision medicine sector since they were one of our top performers last year. And during the quarter, there was a sharp pullback in Editas medicine, with shares down 40%. There were really no negative news surrounding the company during the quarter. Editas is a clinical stage gene editing company focused on developing transformative therapy to treat a range of serious diseases. Editas has been a top performer for us last year, and we think the shares are just taking a breather as long-term growth prospects are pretty strong. In terms of rebalance during the quarter, we had 2 additions to the index, AVANOS Medical and Arrowhead Pharmaceuticals. These 2 companies were previously in our index in the past year or so, but due to scoring changes, they fell out middle of last year. And AVANOS Medical, for example, is in our medical instrument sector. AVANOS is a pure play medical device company with a market cap of $2 billion to address pain management and chronic care while helping patients move from surgery to recovery. Pain management, which is about half of their revenues, uses thermal radio frequency system using water-cooled technology to deactivate the pain that's causing the sensory nerves. The company had deep supply chain issues most of 2019, and growth decelerated significantly. We had to downgrade some of their scores at the time, and it appeared that leadership was a little bit uncertain given some of their operational hurdles. Most recently, we became bullish on AVANOS as they fix their supply chain issues, and the company's on track to experience multiple growth vectors to drive margin expansion. Especially now that elective procedures are on the rise, we believe that AVANOS should benefit from this trend. Meanwhile, Arrowhead Pharma is in the precision medicine sector. Arrowhead is a gene therapy company using RNAi technology to find a cure for liver and cardiovascular diseases. They have strong partnerships with some very large leading pharmas with multiple promising late-stage phase trials are currently underway. Their market opportunity is huge. For example, hepatitis B virus infection affects 257 million people worldwide and causes 780,000 deaths per year, according to World Health Organization. FDA-approved vaccine is available in the US, but today there's still no treatment available for acute hepatitis B once contracted. So it should be really a promising year for Arrowhead in 2021 once the trials are FDA approved. Next strategy we're going to talk about is THNQ, the Artificial Intelligence Index. It is our newest fund focused on pure play AI companies measured by revenue and investments around AI capabilities. It declined 1.2% for the quarter, underperforming the broader market indices. After an outstanding performance in 2020, high growth technology companies, broadly speaking, stalled in the first quarter as investors rotated into cyclical and value-oriented stocks. We think the vaccine rollout and optimism around the recovery in economy and rising interest rates put pressure on technology-oriented shares as many took profit on these winners. We believe that despite volatility in the group, current spending around AI fueled by digital transformation initiatives remain strong. We analyzed dozens of companies on their outlook and increases in their R&D investments that indicate visibility remains strong and demand for AI capabilities and cloud activity will continue at a rapid rate. With a sharp pullback in valuation as well, we anticipate that M&A activity will also pick up meaningfully for the rest of the year. In terms of subsectors, big data analytics, network security were in negative territory, while semiconductor, healthcare, and cloud providers had strong performance. To go a little deeper into semiconductors during the quarter, it was THNQ's best performing subsector, driven by the global supply shortage and strong demand. It is also one of THNQ's largest subsectors. These companies are enablers of AI systems and compute power and are smart devices that we use on a daily basis. We think without semis, we would not have access to the cloud services or see advancements in medical diagnosis or even have autonomous cars in the future. Semis, as many of you know, are going through the most unusual time with supply constraints at the moment. We have been getting a lot of questions regarding the semi industry in the recent weeks and what the impact on THNQ and also for ROBO. So I'm going to spend some time talking about the industry trends. What the semi industry right now, what they're going through is really unprecedented. We have spent a lot of time speaking to about a dozen players in the semi industry in the past few weeks. And we're hearing that the supply shortage that they're witnessing today is possibly the worst in the history of semis. One OEM we spoke to even mentioned that it was the worst in 30 years of their operating history. And it is a very broad-based impact rather than just a smartphone-driven or 5G driven. It started really with the semi industry that experienced two unusual years with US-China trade war in 2019, followed by the COVID pandemic last year, which suppressed supply as factories around the world were shut down for many months. So we were already facing supply shortages for 2 years going into 2021. So today, while factories are generally back up in Asia, we are still having transportation issues with chips There was also a perfect storm of unusually cold weather in Texas, where many of the key fabs are located. And there was even a fire at a key semiconductor company. So starting around December of last year and into 2021, demand has been really surging, causing continued supply constraint challenges. Where we're obviously seeing the biggest constraint is in the auto industry. And few automakers are now shutting down their plants, and new smartphones and PCs may see continued tightness. So new introductions of some of these devices may be delayed this year. So semi companies are aggressively expanding capacity at the moment to meet the demand, but overall supply conditions will last through the rest of the year. Some of the lead times that we're hearing are extending to 52 weeks or more from the previous 2 to 3 months lead times. So we believe that the inventory correction is not over. Layering on top of all these events, overall demand has also surged from key enablers building chip solutions to meet the demands of AI, data center, electric vehicles, IoT, industrial, and 5G networks. So all these trends, it's really, hard to be fully negative because there are really a lot of bright spots as well. We think that we are very well positioned as our index members, such as Microchip, Teradyne, ADI, ASML, NVIDIA, to name a few, have a very strong pricing leverage at the moment. There's a lot of also discussions on prioritizing what is important. And we're hearing from industry checks that AI, electric vehicles, and data center chips are seen as priority. So these chips have higher selling prices, and the capital equipment to produce these chips have already been ordered. So overall, we believe that the chip industry is a key enabler of digital economy, and near and longer term, semiconductor demand will continue to rise from the reopening of the economy, and the supply environment might be tighter with coming quarters, but should even out in 2022 and beyond. So while we don't see the supply improving until 2022, demand will continue to surge, and visibility surrounding what is being built today makes us really excited about our THNQ and ROBO members who will be the beneficiaries of these demand trends. So meanwhile, big data analytics subsector declined 11% during the quarter, and were detractors for various companies. Big data analytics was one of our top performance 2022, but basically gave back some of the gains. THNQ index members such as Alteryx, Appen, and Splunk suffer losses driven by longer sales cycles and push-outs of very large AI projects, as enterprises are still prioritizing the needs of the remote workers. As we witness the massive cloud deployments that are continuing through this year with continued vaccine rollouts throughout the world, and some of the employees are returning back to the office, we believe that AI solution providers will recover rather quickly, as we need AI capabilities to extract intelligent insights in this data-driven world. Bill covered talent earlier, and I will just highlight that the stock surged 66% during the quarter, and data analytic company talent rose 150% in the past 12 months or so, with double-digit sales growth expectations. Another winner during the quarter was ASML. The company holds a dominant position in providing EUV semiconductor capital equipment for all the leading players in the semiconductor industry. The most recent quarter demonstrated that EUV demand continues to be very robust with a healthy backlog. About 30 billion of EUV orders reflect customers' desire to invest in disruptive technologies such as AI and edge computing. Tight supply capacity, as I discussed earlier, has significantly increased ASML's growth prospects and visibility over the next several years. Meanwhile, Appen, a data analytic subsector company, was a negative performer during the quarter. Appen is a leader in labeling data for training AI models with AI-assisted platform. AI was one of the companies that were negatively impacted by AI projects getting pushed out, but we believe that enterprises are now focusing more on data quality and data integrity. And the long-term prospects from companies like Appen will recover as the economy continues to open, as AI is playing a critical role in the data journey for all the enterprises that are undergoing digital transformation. In terms of rebalance changes, we had some meaningful additions during the quarter. We added 5 new companies to the index. MediaTek is a Taiwanese producer of integrated circuits powering more than 2 billion devices a year. Its core expertise and what they're known for is really multimedia. And their vision is to be a dominant player in enabling intelligent smart devices and appliances for the new digital world. Its AI platform solution differentiates itself by developing products with next generation AI processing at the device level. NICE is an Israeli-based cloud provider with core competencies in enterprise contact centers and also security solutions for the government. In most recent years, they have also introduced financial crime and compliance solutions using AI capabilities. The company has a long operating history with industry-leading margin profile. JFrog and C3 AI are recent IPOs in the past 6 to 7 months in enterprise AI segments. They are market leaders in its respective space. We're very excited to have the opportunity to add these pure play AI-driven software companies to the index. Global Unichip is a company that was previously in the index, but the recent scoring changes brought the company back. Global Unichip is an early pioneer in providing ASICs and designing wafer products. Its growth prospects are really driven by AI, supercomputers and data centers, and also blockchain over the coming years. And now I'm going to turn this back to Bill.
All right, Lisa, thank you for the update. Well, with that being said, we hope that was a sufficient sort of overview. We're happy to answer any questions you have. I do see that there's several in queue, which we're happy to answer. The first question was an interesting one that we get fair often, is what's the overlap amongst the three ETFs, and can a company possibly qualify for all 3 indices? Actually, what you'll find is all of our indices have pretty unique exposures. They have extremely low overlap, as we discussed with traditional indices, but there's also very low overlap amongst our 3 indices. If you looked at THNQ and HTEC as an example, the overlap is only around 4%. For ROBO and THNQ, it's about 14%. And the same thing for ROBO and HTEC, it's roughly around 12 to 14%. So very low overlap. I'm not sure, Lisa, if you had any other comments.
Yeah, I mean, I think the second question is that can a company possibly qualify for all 3 indices? Nuance is a perfect example where it qualified under ROBO, as well as THNQ for their pure play AI-driven business, as well as the HTEC for their medical business. So 60% of Nuance business came from the healthcare industry. So that's one of the few companies. I wouldn't say we have many of those, but I would say there are some handful of companies that have the medical exposure, as well as our AI-driven, as well as being involved in some of the robotic platforms.
Next question, is there a particular industry or technology catalyst that you're watching which could accelerate robotics adoption? I'll take a quick stab at this. I have a hard time identifying one specific catalyst. I think that we're in an undeniable inflection point because of computing capabilities, which is essentially doubling every 18 months, and our cost of computing is decelerating, which is leading to an array of use cases, which a few years ago was just Elon Musk science fiction. So as we look at the penetration rates across virtually all indices or all segments of the economy, we're at very low penetration rates. The most heavily automated area in the economy is obviously industrial manufacturing, which is roughly around 40% sort of automated. Interestingly, if you look at industrial use applications, it's estimated by the end of this year, we're going to have roughly 3.1 million industrial robotic installations. That compares to a global installed base of industrial manufacturing employment, which is about 380 million people. So if robots are stealing our jobs, they're doing a bad job of it. And if you actually look at robotic installations relative to employment, you'll actually see people think that robots are stealing our jobs. Well, in fact, there's no evidence to suggest that. The correlation between robotic installations and employment is virtually 1-to-1. And you can see that with what's happened with Amazon. I mean, Amazon over the last year has added, I'm not quite sure how many robotic installations, but they've added 500,000 people. So we think that the area is open field in every subsector. And maybe Lisa, if you have any comments, please chime in.
Yeah, I think the only thing I'd like to add is that in terms of the technology catalyst is that we're seeing a lot of advancements in AI software. So the robotics, the next generation robotics that you're going to see that we think will possibly kind of accelerate or spur some of the adoption would be having the robots be a little bit more intelligent. So, and that is possible with some of the kind of a deep learning type of algorithm. So we're seeing a lot of advancements in supervised learning algorithms that's going to allow the robots to make some human-like type of decisions. So it's going to be very exciting to see some of that technology innovation happening.
Okay, next question is how do you, I guess, qualify IPOs to get added to the portfolio? I guess a question on SPACs, how do they qualify as an underlying company? First of all, what's really important to recognize is that we're trying to identify companies that have high revenue purity. We didn't really discuss our industry selection process, but we now have a proprietary sort of ranking system where we look at companies on the basis of 50% of the sort of factor ranking is related to the revenue exposure, and then the other 50% is related to identifying companies that have strong market share leadership, have strong technology leadership, and also are investing aggressively such that you are going to see a pickup in their revenue mix, and you will also see a benefit of improved margins. So that's essentially how we do it. We're not really throwing paint against the wall. Again, we're trying to identify industry leaders. Lisa, any thoughts?
Yeah, I think that's right. I mean, as a research analyst, whether you're an IPO or a SPAC or a company that's been established for 30 years, you go through the exact same process getting into the portfolio. We have an investment committee. We discuss some of the scorings and factors, market leadership, technology leadership, as well as what type of investments have you made, as well as the revenue purity is a very important factor for us. So you have to meet a certain type of threshold to get the scoring. And then we go through the ESG filtering process as well to screen out the companies that are violating some of the ESG policies. So it's exact same way. So when we do look at a company that's relatively new, we do get excited to see, to understand a new story. But at the end of the day, it goes through the exact same research investment process.
Okay, another good question. Obviously, there's been a lot of attention related to electric vehicles. Is this a growth area for AI? And are there companies that are well positioned to support the hardware and software demand for EVs? And are these companies represented in the THNQ portfolio? Just briefly, the answer is yes. I think that we have strong exposure to autonomous vehicles in not only THNQ, but also in ROBO as well through our computing, processing, and AI and sensing as well. So we do inadvertently capture a lot of this growth. But let me pass it over to Lisa to go into some more granular detail.
Yeah. We think that EVs are definitely one of the biggest growth areas for AI. A lot of people do interchangeably use the word EVs and autonomous, even though they're not the same. But we are seeing that almost all of the EVs are using a lot of autonomous type of features. Right now for THNQ portfolio, the biggest exposure and companies that are supporting the hardware and software are companies in the semiconductor industry, because the EV is still relatively very new and we're still in the process of building them. So companies like NVIDIA, ADI, Infineon are enablers, and also ASML has been seeing a lot of orders for their EUV equipment for companies that are producing these chips are going to go into the EVs. We also have a small exposure in Tesla in our cognitive computing subsector, and that's also been a very good performer for us.
Okay, thank you, Lisa. Next question is that are there any plans to focus less on the US given the current valuations there? The answer is not necessarily. We're not come up with concrete levels of exposure we want to have. We're trying to identify the companies that, again, have the highest revenue capture and that have the best technology. So we're somewhat agnostic to where the company is based. As it works out, the US is slightly larger than international, but we're pretty close to 50-50, which we think, bodes well in this environment, given some people's belief that the US is a little bit rich relative to international markets. You would see that with our valuation, Robo, we trade about a 25% premium to our historical PE level. But importantly, we're seeing a pretty noticeable uptick in our growth. And if you look at our growth, it's actually about 25% lower than it was at the peak. So we think there's ample runway for growth in the US. Lisa, any thoughts?
No, I think that's it.
Okay. I guess other than robotic floor cleaners that are popular today, what are the next areas for domestic home robotic technologies? I'll take a quick stab and then pass it to Lisa, because Lisa actually just did a quick video with the iRobot management team, or one of the members. But I would say that generally speaking, you're probably not going to see too much advances over the near term. I know that Amazon is working on some domestic solutions, but I think you have to have a price point that works. There needs to be a value proposition. These are complex applications that you're trying to get done. And I think it's going to take a little bit of time for this to play out, probably 5 to 10 years, but I'll pass it to Lisa for some more thoughts.
We've seen a lot of interesting technologies out there. We've seen, kitchen robots, robots that can make pizza and some of these items. We think we're going to see a very meaningful kind of TAM opportunity is really around that companion robots, as well as the personal robots. So robots don't really necessarily have to mean that you have to have arms and legs and have this robotic features. It could really be a speaker that you could actually talk to. Right now, we do have a smart speaker, but it's really more command driven. I think going forward, we're going to have sort of a digital assistant robot that you could not only have ask questions and get answers, but actually have some dialogue with. And maybe they'll make some appointments for you. So if you say, oh, what's today's date? This robot will remind you that your dental appointment has to be booked. So maybe that robot will help you. So that digital type of robotic assistant with lots of kind of the advanced software AI is where we're seeing a lot of the home robotic system is being built today.
But I still think the sort of consumer application is going to take a little bit of time to play out. Next question is, do you have a portfolio rebalancing policy? If so, please describe it. Yes, we do. We rebalance quarterly to smooth out the ride. Just so everyone kind of understands, our approach. We again sort of look at this and try to get investors from point A to point B in as least turbulent aerospace as possible. That's why we're not concentrated, roughly our top 10 names are kind of in the 15% of our exposure. We rebalance and basically trims our winners and buying the stocks that have gone down. And essentially, we're buying in, or we're trimming 2% positions and adding to, roughly 1% positions. And we do this quarterly again to smooth out the ride. And I guess this is the final question is, maybe I'll pass this to Lisa. Can you discuss your ESG filtering and maybe provide some examples of companies that were filtered out?
So we have, during our investment process, as I mentioned earlier, we have these investment ideas through the investment committee, and then it has to go through the filtering, looking at the environmental, social governance. We use a third-party provider, Sustain Analytics. They are very well respected in the community. We also use the same principle, guiding principle of the UN. So these, we're very comfortable with using these third-party guidance. And in terms of examples of companies that are filtered out, the ones I could recall are in the energy sector. We went through some of the companies that, regardless if they had the robotic type of equipment that we were seeking for, it did have some violation according to Sustain Analytics in terms of the environmental impact. So there were a couple of companies that were removed.
We certainly appreciate everyone's time, and everyone has a busy schedule, so we'll let you all go, but we're pretty excited about where we're going in terms of the growth and direction in robotics, AI, and healthcare innovation. And again, we try to capture companies that aren't in most traditional indices, and we think that it will likely complement many of your portfolios quite well. And we look forward to having conversations with you and helping to educate you further. So with that, thank you for all your questions.
Thank you.